In this video, I'll be covering what you should do as the market is crashing, either as an investor or an observer. Just before I begin, my name is Mihir and welcome to my YouTube channel. I upload financial educational content such as this 3 times a week, so if you're interested, please hit like and hit subscribe as this truly helps me out. Besides that, let's get straight into the video. Right now, due to the recent situation in the economy, the S&P 500 has fallen by 14% in the past 3 months. So essentially, the S&P 500 is sort of like a global market index. So just like how we have the ASX, so the Australian Stock Exchange, we have the S&P 500. And the S&P 500 tracks the top 500 companies throughout the globe. And they've seen a fall of 14% in the past 3 months. And that is not good, ladies and gentlemen. And some of you may be wondering, oh yeah, I haven't invested any money into the stock market. Yeah, why should I worry? Why should I care? First of all, there's 2 reasons. Firstly, opportunity, and secondly, you technically have invested in the stock market. The thing is, most people, or most Australians don't know, is that their super fund invest a huge chunk or huge portion of their money into the stock market. And most people don't specify whether they'd rather put a huge chunk of that money into real estate or just other assets or other vehicles. But since they all go with the default options, that's what they get. And hats off to anyone who knew that their money was invested in the stock market through the super, because sadly, most Australians do not know that. Now you may be wondering, okay, everyone seems to be on the same boat, so Mihir, what do we actually do? Contrary to what you guys may be thinking, I do not want any of you to sell your investments. And the reason for that is simple. If you look at past or history, let me just give you some perspective, alright? You can see that the stock market has always gone up, right? There's times where it's gone down. It makes sense, alright? It plateaus, it goes down, it just spirals, but it's gone up in the end, in the long run, alright? So if you're someone who's like 20s and 30s, 40s, basically not close to retirement age, I highly suggest you hold on. Like, just hold on, please. But if you're closer towards your retirement age, you may be wondering, oh, Mihir, what do? I'm going to retire soon, and there's not enough money in my super. For that, I suggest and highly encourage you to sit down and talk with a financial planner or an advisor, because they are professionals at this and they know what they're doing. So please consult with them. But the general consensus for most people is that they should hold on, right? When I was saying, talking about individual stocks or mutual funds, there's obviously more vehicles, but those are the sort of ones that stick out, is that they depend on a lot of factors, such as individual stocks. It depends on the company's cash flows, their debt, and just their management, just so many factors. But you got to actually research the company. And the thing with mutual funds is that they're trying to beat the market. Like, beating the market doesn't work. Like, it doesn't really work that well. I'll show you another figure or something, ETFs versus mutual funds. Otherwise, ETFs always beat mutual funds. Alright, and mutual funds are also more expensive. But if you'd like to know the difference between ETFs, mutual funds, and stocks, I already made a video and I'll leave a link somewhere up here, so please check that out. That will clarify everything. The primary reason I made this video is because I don't want you guys to make decisions based on emotions. We humans may argue, yes, we're pretty logical creatures and things like that. However, we run purely on emotion, alright? That's a fact and no one can defy that. But if you look historically, the stock market has always gone up, and the reason why I keep just presenting this figure onto you is just to give you some perspective. We've encountered issues like this and it will always go up, otherwise we'll be in like an apocalyptic or a dystopian future. Just before I go deep into a detailed analysis, I just want to alert my subscribers that some of the videos I made in the past link to this, so I highly urge you keep watching, because I show you how it all links up together like a puzzle piece. And besides that, please hit like and hit subscribe if you're not a subscriber and you're enjoying this content. Now proceed on. The first step I recommend you guys to do is have at least 3 months of expenses in your savings account, because let's say, God forbid, you somehow lose your job, as because 25% of the Australian workforce is projected to be employed, you could be one of that number. So it's good to have savings so that you can find a job sooner or later. Otherwise, I don't want you guys to move on to the next step. So I'll commence my next step now. Just before we get into ETFs, what I want to say and elaborate is that just because I'm buying a specific ETF doesn't mean you should do the same, right? You should make it the norm. What I want you guys to do is do your own due diligence and research. I know that ETFs are pretty simple and for like a beginner sort of investment, because you don't need to know a lot, but I still want you guys to conduct your due diligence. Or if you're still not sure, I highly encourage and suggest you sit down with a financial advisor and ask him more. But besides that, let's get straight into the ETF. The reason why I preach ETFs so much is that the risk is so low. Like, most people are risk adverse. They rather not take risks. They're afraid. And the thing is, this is the perfect vehicle for them. However, they still have preconceived notions and sort of myths and misconceptions just in their head that, oh, this
investing is risky, investing can do that.
ETFs negate the whole risk. So what ETFs are, they basically stand for exchange traded funds. So you can sort of think about them as a company you pay your money to, right? And they pool your money alongside other investors' money and invest in a huge chunk of companies and diversify. So essentially, one of the stocks I've got, I'll put it up here, is the ASX Top 200. So like it's the Aussie Top 200 companies, right? So essentially, I have put my money in the top 200 companies in Australia, right? So it's just diversified amongst the top 200 companies, right? So I don't understand how this is risky, right? They're the top 200 companies. Let's say some of them theoretically go some whatever way, go bankrupt. Let's say 10 of them. You still have access to 190 more companies, which is insane. And another factor that I want to emphasize is that the dividend distribution is higher than your interest rates. Right now, your bank's interest rates, right, due to this recent situation, have even gone further lower. Otherwise, they're still below inflation. And if you're not sure what inflation is, I'll just leave a link, otherwise I'll briefly explain it here. Inflation essentially is the cost of living, right? Everything's been gradually increasing, but your wages have been not really, and especially the interest rate in your bank account. If it's below inflation, you're losing money. So the best way you can sort of think about this is like a coffee cup, right? I'll show you a diagram up here. Otherwise, a coffee cup would have been cheaper in the 1950s, or a really old time, compared to now. It would have raised in price, right? Everyone knows that things are gradually getting more expensive, but your wages aren't increasing at the rate that is sort of complying with inflation. And somehow your job wage isn't really increasing. So I'll put up a graph here as sort of a diagram just comparing the numbers, and you can see that the car payments increased, university tuition fees increased, buying a house has increased, raising a child has increased. Well, your wage, no, it hasn't increased much. And that's the truth of reality. That's just reality. And then what most people do is they believe, okay, if I put money in the bank, right, it's compounding. It's a good idea to get that compound interest thing going in your head, but it's below inflation. You're losing money. I mean, if the cost of living is here and you're making interest like here, it's just going to further keep dividing. There's no future or possibility for it. I know there may be times where inflation might be below the interest rate, but that really doesn't happen much. Not at all. Now you may be scratching your head and saying, well, Mihir, why doesn't everyone have ETFs? Well, technically they do have ETFs in their super fund, which is what the superannuation fund manages. But otherwise, what I'm trying to say is that if you're expecting such a low risk, you surely cannot expect a high return. With low risk, you're going to get low return. However, this low risk is so good and it's so viable that this can actually be a lifelong thing. And that's what many people do. So essentially, most people retire around 65, but through this asset, people retire within 10 to 15 years. It truly is possible, and the way they do that is to a dividend reinvesting strategy, or basically retire off their dividends. And if you don't know what dividends are, you can essentially think of them as, so I'll just give you a brief example, is that a company gets profits, right? And essentially they can either put that back into the business or they can give it to their shareholders. And companies are not obliged to do this, however, some still do this. And some companies have stopped dividends and the results were not too good for them. But besides that, a benefit that I want to say or preach to you guys is that the dividend rate or the distribution rate is much higher than the interest rate. So think about it. If you're going to get paid more through ETFs than the bank interest rate, why would you go for that? And the dividends sort of vary, obviously, depending on which one you go. High interest ones can go around 4%. But the one I've gone, the Aussie Top 200 ETF, I've gone with mobile, just keep referring to this one. It's around 3%. However, due to this recent incident, it will probably just fluctuate and be volatile. Just to give you guys a practical example and drill it further into your head, I'll be talking about my own situation. So essentially, I'm with ANZ and I have an online saver account. I used to be getting an interest rate of 1.65%, but now I've got an interest rate of 1.22%. So it's dropped quite a bit due to a recent incident in the news. But what I'm trying to say is that inflation was around 1.8, 1.9% this past 2 months. I mean, the data's slightly old, however, that's what it was. And as the Reserve Bank is printing more and more and more and more money, this constantly allows more people to get hands on more money. So the banks are lending out more money to stimulate the economy. And if more people have more money, that's in theory, guys, in theory, should raise the value of the asset as you have more competitors fighting for the same thing because they have more money. So you sort of what I mean? So the playing field must be upped as all of them have more money. So essentially it just raises the value of the asset. However, Due to this process, this can also cause hyperinflation or stagflation, which is basically inflation on crazy levels. And this is not good at all. Because like I said, inflation, right? Most of you are earning below inflation, and your interest rate is also below inflation. But now think about it, if it just went 2, 3, 4 times higher, what would be the impact? It would be insane. Everything would be so expensive, and that would cause a lot of issues in the long run. But the whole preface and the idea I want you guys to grasp from this video is that I don't want you guys to miss out on this opportunity that's being presented. Right now is a good time, right? It's one of the greatest times, right? Warren Buffett has a really famous quote. It's like, be fearful when others are greedy, and be greedy when others are fearful. It's one of the best quotes, and it works almost anything. I don't understand, if you're gonna follow everyone else, how do you think you're gonna get results that some people get if you're gonna follow everyone else? It doesn't make any practical sense. But obviously, I just don't want you to put your head and try to run like a bull. I want you guys to do your own due diligence. And I've already presented you with the graphs, but now it's your turn. I challenge you and I urge you to do your own research and basically make the best of this opportunity that's being presented to you. Besides that, I thank you for watching this video. I really hope you enjoyed it and it served you and provided value. And if it did, please hit like and hit subscribe, as this will truly help me out on my path towards getting 1,000 subscribers. Thank you for watching. Goodbye.